The US 10-year, simple chart, shows the trend we've been in, 2.6 versus 2.2 since the back end of last year. You're saying a sell-off's like, a lot of people have called it, Eric.
True. I guess, well, what I think there's a danger of missing here is there's a risk of a more material change in investors' risk perceptions. Right, so a lot of the move has just been about, if you look at what happened last year, you'd had those very extreme rallies in the bond market around negative rates in Japan, then around Brexit in the middle of the year. So in a sense, the market was very, very vulnerable to a material shift in yields. That then became consensus in that latter part of last year, the early part of this year. And I think you've just seen some degree of moderation. Frankly, those aren't particularly big moves. But investor beliefs have become a bit more complacent. I think there's a lot of noise recently in the inflation data that people are focusing on. The real insight for me, though, is if you look at something like the 5-year real return to treasuries is now negative, right? So on a 5-year view, you have lost money in real terms investing in the bond market versus the S&P 500 up 80% real. So the opportunity cost actually in the bond market has been extremely high. If those investor perceptions shift, you could get another very material move in the bond market.
Eric, this is our WERP function. It's a wonderful function. And, as you know, it tells us that there's going to be a rate hike in June. But beyond June, it's telling us, at best, 30 or 30%. Why? Why aren't bond investors convinced?
Well, I think,
beyond June.
Okay, well, first of all, what you've got to remember is the bond market is comprised of various factors. So you've got short-run Fed funds rate expectations, but you've also got the yield curve and term premia. If you look at 2-year yields, haven't moved very much this year. So this has not really been a bond rally associated with a change in rate expectations. This has largely been about term premia. So it's about the riskiness or the perceived safety or riskiness of owning bonds. Really what I think may happen is that people are not focusing on a potential shift in real interest rate structures. So even if inflation doesn't do very much, real interest rate structures can move an awful lot. But the other thing that can move an awful lot is term premia. Yield curves can steepen by 50 or 100 basis points without the Fed doing anything. And what bond investors are waking up to in America is you've actually been in a bear market in bonds after inflation for quite some time now. And once there is a perception that these are not safe assets or the price of perceived safety is actually negative real returns, the opportunity cost of not embracing volatility, which is an 80% real return in the S&P 500, if that affects people's risk perceptions very materially, you could get a big change in the dynamics of the bond market. And it feels to me as if bonds here are particularly complacent. They've been taken up with noise about short-run inflation dynamics, an excessive focus on what the Fed and market participants think is going to happen to rates. The truth of the matter is nobody really knows on a 12, 18-month view what the Fed is going to need to do. But the broader point here is that the opportunity cost of being long of bonds is now very high.